Okay, welcome back, everyone. Welcome to our options education webinar series. Today, we're going to be talking about trading debit and credit vertical spreads. This is one of my favorite strategies for trading options because it really allows you to take any directional view on any stock or ETF and be able to take that directional view with limited risk. One of the biggest benefits to trading options is that it allows you to take directional views and take bets on the market while limiting your risk to the amount that you've either paid for the option or to a predefined amount, which is really important for money management for trading in general, not just options. So today we're going to be talking about the two most popular spreads that you can trade for directional views using options while limiting your risk. Now, the reason that I want to talk about this topic is because I've generally found that a lot of people think of debit and credit spreads as relatively similar. One's debit, one's credit. But in reality, they're actually really, really different from each other. They should be used in completely different scenarios and completely different outlooks on the market. So that's why I want to spend the time today to really dissect the difference between debit versus credit spreads, understanding how they're constructed, when you should use it, so that you are applying these strategies correctly when you're trading options. Now, my name is Tony Zhang. I am the Chief Strategist here at OptionsPlay. I'll be walking you through this webinar here today. I'm going to spend about 20 minutes on the slides, and this webinar is recorded. Not only are you going to receive the recording after we finish here today, you're also going to get these slides so that you can, and there are some important links in these slides for those of you that are brand new to OptionsPlay. I want to make sure that you have access to the previous webinar recordings that we've done, access to OptionsPlay Canada. For those of you that don't have access, there's links to how to get access to that free of charge through the Toronto-Montreal Exchange. Also, for those of you that trade U.S. options and is looking for similar type functionality for U.S. stocks, I've included a link on how to access that. And lastly, starting your U.S. OptionsPlay subscription. So really important links. Make sure you look at those. Like I said, this webinar is recorded. I will spend about 20 minutes on these slides, really talking about what are vertical spreads, when should you use them, and how to trade them effectively before I move on to using the OptionsPlay software to actually show you how to analyze these strategies side by side so that you're applying them correctly for your trading. So you'll receive the recording after we're done here today with the slides, and we're just going to go jump right into it today. So first off, I want to talk about what are vertical spreads. Now, before I get started, for those of you that have traded options before, please type options into the chat window. And for those of you that are brand new to options trading or just learning, please type new into the chat window just so I get a feel for the audience here in the room and who's new to options and who's been trading for a while. Okay, so quite a few people who have traded, but also at the same time, quite a few people who are brand new. Okay, so for those of you that are brand new, what I will cover is the difference between debit versus credit spreads, as well as how to construct them. And I really hope that this webinar inspires you to take a look at options trading, not only specifically regarding these strategies, but also utilizing our platform for all types of different outlooks and strategies that you can utilize options for. For those of you that have traded options, what I really hope to show you guys here today is, number one, what are the best practices for trading these types of strategies? And most importantly, I want to show you how easy it is to actually compare these strategies side by side so that you can quickly find the strategies you want to trade using our tool OptionsPlay compared to using an option chain, okay? So those are so regardless of whether you're new or experienced, there's something for you to learn here today. We're going to start off by talking about what are vertical spreads, and I've divided them down between debit spreads and credit spreads, and we're going to analyze the difference between the two here today. So when we're talking about debit spreads, these are spreads that cost money to get into the trade and receive a credit to get out of the trade. And for bullish trades, you would trade a long call vertical. For bearish trades, you would trade a long put vertical. Very similar to buying a call or a put. You buy a call if you're bullish, you buy a put if you're bearish. Same thing for debit spreads. You have basically the same call vertical for bullish trades, put vertical for bearish trades. For credit spreads, these are spreads where you actually receive a credit to get into the trade, but actually have a debit to exit the trade. So basically reversing the transactions when you get into a credit spread, and for that, everything is also reversed basically. For bullish, you would actually short a put vertical, and then for bearish, you would actually short a call vertical. So basically the exact opposite of a debit spread. So you could really think of the two as opposite of each other to some degree. So let's talk a little bit about how to construct them. Now, this is really for those of you that are brand new to this strategy. If you've never traded a vertical spread before or any spreads, one of the key reasons that I like to trade vertical spreads is because of the fact that you have predefined risk and reward on each strategy. And the reason that predefined risk and reward is attractive to a trader like myself is because it really allows me to plan for a trade ahead of time. Meaning I know exactly what my potential profit is on a trade, I know exactly what my potential risk is on a trade, and I can plan for that. It's really easy to, once you have those bearings, to be able to understand where you'll be at any point of the trade, and nothing surprises me because I already know what my best case scenario and my worst case scenario is. And that's really one of the benefits of trading vertical spreads. Unlike trading some other strategies like buying a stock or buying a call, you don't necessarily always know what your expected outcome is on the upside. You might know what your expected outcome is on the downside because your risk is limited in those cases, but how much money you can potentially make is unlimited, and you really aren't sure as to how much money you're going to make, which is why for me, that's always a little harder to plan for. And what it does is during when I'm in the trade, it brings up some emotions because you have to figure out at that time whether you want to take profit or cut losses. With predefined risk and reward, I already know exactly when I'm going to take profit and when exactly I'm going to cut my losses. And it just makes planning for things a little easier and removes the emotional piece from trading. So what I'm going to do is I'm going to talk about how to construct a vertical spread, both debit and credit spreads, using a fictitious stock XYZ trading at $100. And I'm only using this just for illustrative purposes to show you guys how to construct this. You don't have to memorize this. This is simply just for illustrative purposes so that you understand how to construct them. Our platform actually does the construction for you. So again, you don't have to memorize this. But we talked about debit spreads. The bullish trade is the long call vertical. So for a stock XYZ trading on $100, a debit spread typically looks like this, where you buy an at-the-money call. So perhaps you're buying the 100 strike call. And what you're doing is that will cost you some amount of money. And to offset that cost, what you do is you sell a higher call. And that brings in a little premium that helps offset the cost of buying a $100 call. So what that does is lowers your risk, lowers your break-even price. And with the debit spread, because you're short a leg, it also helps mitigate that time decay factor of when you're long an option. For the bearish trade for a long put vertical, what you do is you do the same thing, but except this time you buy an at-the-money put instead of a call. So a $100 put, the at-the-money puts, and what you're going to do is you're going to sell a lower put against that, and it does the same effect. It lowers the cost of buying that $100 put, which offsets your total risk, offsets your break-even price, and also at the same time offsets that time decay. So very important understanding is that basically traditionally if you were trading single leg options, you would just buy the $100 call or $100 put if you're bullish or bearish. Now what we're doing is we're just adding one more leg to that to help offset the cost of buying an outright call or a put. And there are some additional benefits to that, which I'll show you there in 1 second. So when we're talking about credit spreads, it's just the exact opposite. So when we're talking about a bullish trade, we're talking about the short put vertical. This is where you, instead of buying that $100 put, you're going to sell that $100 put. Now, when you sell a put, you have unlimited risk. So in order to offset that risk and help cap that amount of risk, what we're going to do is we're going to buy a lower price put. So what we're basically doing is we're flipping the buys and sells from a long put vertical to a short put vertical. And what that turns the trade is from a bearish trade into a bullish trade. So the short put vertical here is the bullish trade, and the bearish trade is the short call vertical. That's where we're going to sell the $100 strike call. We're going to buy the 110 call against that to help offset the unlimited risk that we have when we sell a 100 strike call. So this is really where this is how you would construct both a debit and credit spread. Like I said, this is for illustrative purposes. You don't have to memorize this. Our platform does all of this. This is just designed to let you know how to actually construct one of these spreads. So Now that we talked about how to construct them, what I want to talk about really is best practices on how to construct them, from both how do you pick your expiration date and how do you pick your strike prices. So when we're talking about debit spreads, these are fairly straightforward to construct. There's not a lot of subjectivity that in my opinion, that goes into these. I think for the most part, anyone that trades debit spreads, for the most part, constructs them relatively similar. Basically, you're looking at expirations that are greater than 1 month. And the reason for this is because you want to minimize theta. You want to minimize time decay whenever you're long an option. And one of the best ways to do that is to buy longer dated options. Anything 1, 2, 3 months out is typically where most people are trading debit spreads. Now, we talked about having 2 legs for each one of these vertical spreads. So when we're trading debit spreads, typically what we do is we buy the at-the-money option. So anywhere from 50 to 60 delta is usually a good place to start for the long leg. And then we always sell another leg against that. We sell an out-of-the-money option. So what do? We typically sell an out-of-the-money option that's anywhere from about 10 to 15 delta. The reason we use a 10 to 15 delta call or put against the long call or put is because the 10 to 15 delta, generally speaking, is relatively far away from the current price, and it has a relatively low probability of the stock hitting those prices, but it also still has enough premium to help offset the cost of that long leg. Usually you're offsetting anywhere from 10 to 20% of the cost of that long leg. And that 10 to 20% savings in the cost of the option not only helps help increase your returns when you're right, but also decreases your risk when you're wrong. And that's really one of the biggest benefits of trading debit spreads versus just buying a call or a put, is reducing your risk and magnifying your returns when you are correct. When we're trading credit spreads, this is where there's a lot more subjectivity. Depends on how you like to trade credit spreads. There isn't really a good rule of thumb here. However, based on all of our back tests, we generally have found that the optimal credit spread is to receive, in terms of credit, about 1/3 of the width of the vertical. When I talk about the width of the vertical, that simply is referring to the distance between the 2 strikes. So when we talk about selling a $100 put and then buying back a $90 put, that's a width of $10, the difference between the $100 put and the $90 put. So really important to understand that you want to collect roughly 1/3 of the width. So if you have a $10 width of a credit spread, then you want to collect roughly about $3.33. If you're trading a credit spread that's got a $3 width, you want to try to collect about $1. That helps you kind of figure out exactly how far apart the spreads, the 2 legs are, but also how far away those 2 legs are from the current price. Now, generally speaking, if you stick to this type of rule of thumb where you collect 1/3 the width of the vertical, you're going to find that you're going to need to sell a slightly out of the money option. So about 40 to 45 delta is usually where you want to start as a starting point, selling slightly out of the money options and then buying back or long a further out of the money option. That is usually around the 20 to 25 delta. That's where you're generally going to find where you're going to collect roughly 1/3 of the width of the vertical. If you go any further out, meaning if let's say you sold the 20 delta call and bought back a 5 delta call, you're going to see that you're going to receive a much, much smaller percentage of the vertical width. And I do have a separate webinar specifically just on trading credit spreads. For those of you that are interested in this specific strategy and learning more, I highly recommend you to take a look at that. But the one thing about trading credit spreads is that because when you're trading credit spreads, you actually want to maximize time decay because you're short the option. You want time decay to work in your favor. So we generally choose options that are less than 1 month when we're selling credit spreads. So that's one of the big differences between trading debit versus credit spreads, is picking expiration dates. When you're picking debit spreads, you want to choose longer dated expiration dates. When you're trading credit spreads, you want to choose shorter dated expiration dates. So now that we've understood a little bit about how to construct debit versus credit spreads, we understand a little bit about what are the best practices for selecting expiration dates and strike prices. Next, what I want to do is make sure that everyone understands kind of what it feels like to be a debit or credit spread trader, because it is very, very different from each other. And it takes a different mentality to trade debit spreads versus credit spreads. And before we can get into that, what I want to discuss is that all trading, doesn't matter whether you're trading options or stocks or futures or Forex, what you're really trading off between any type of trading is probability with risk to reward. Anything that has high probability will have low risk to reward. Anything with high risk to reward will have low probability. So when you're trading debit versus credit spreads, they tend to be on opposite ends of the spectrum. One's not better than the other, but it is important to understand the difference between the two. When we're trading debit spreads, you generally will have lower probability of profit on your trades. So typical debit spread traders, you'll see that a lot of debit spreads will have 30, 40, 45% of probability of winning, and about a 60% probability of losing. However, what you get is you get high risk to reward, meaning for every dollar you risk, you're going to generally receive a much higher reward for that dollar that you've put at risk. So chances are you might risk $50 to try to make $100. So this is tradition. Excuse me. This is the type of trading that you would typically see when you're as a debit spread trader. As a credit spread trader, so it's basically the exact opposite. Credit spread traders will typically see high probability of profit. So something like where you have 80% of your trades are winners and 20% of your trades are losers. But the trade-off here is that you're going to risk substantially more money if you're wrong compared to the amount of reward that you're going to receive if you're correct. And all options trading is really just trying to find the balance between the two. However, like I said, these two different strategies are at opposite ends of the spectrum. Like I said, one is not better than the other. Everyone certainly has their own preferences of what they prefer. Personally, for me, I prefer trading debit spreads because I don't like to risk more money than I'm actually collecting on a trade. I don't like the fact that I could make $50 on a trade, but also if I'm wrong, to lose triple that. That doesn't sit very well with me. I prefer to risk less money to try to make more and accept that I have less winners than the other way around. But everyone's a little different. Some people really like to chase these high probability trades and they're okay with taking that risk when they are wrong. But each one is different, so it's really important just to understand the difference between the two and make sure you understand that mentally speaking, they are very, very different. And here's an illustration of that. So what I wanted to do is also illustrate kind of what it feels like to be a debit versus credit spread trader. So like I said, when you're trading debit spreads, you're going to have less winners, but you're going to have bigger rewards. So here's 5 trades that I have that looks what it might look like to be a debit spread trader is you might have 5 trades where 3 of them actually lose money and you're losing $50 on each trade, and you only have 2 trades where you're making money, but you make $100 on that trade, and your end result after 5 trades is you make a $50 profit. And what I've put down here, the same thing is for a credit spread trader, very different way of trading. Instead of having more losers than winners, most of your trades are winners. You're going to collect $50 every single time, but on one trade, you end up losing $150, and that wipes out the last 3 trades. Your end result is the same. You still make the same $50 profit. It's just a completely different path to how to achieve that. Like I said, one's not better than the other. It's just a matter of personal preferences. However, I do want to point out that these 2 strategies should not be utilized completely on their own. And what I mean by that is I want to discuss when is actually best to use these vertical spreads, because they are used for very, very different scenarios. And this is the part that I feel that a lot of credit spread and debit spread traders aren't fully aware of, that I want to make sure that is kind of understood or better understood by those of you that are already using credit spreads or debit spreads. So first of all, when we're talking about debit spreads, these strategies are ideal when you expect a large or quick move up or down in the underlying stock or ETF. So it's only useful if you're expecting a fairly large and quick move in one direction or another. This is typical for those of you that are comfortable with using technical analysis for trading or using the charts. If you've identified a breakout or a breakdown or a stock that's about to make a big move, this could be a bounce off a support level or bounce off a low or resistance level. These are the types of setups that you typically are looking for to utilize a debit spread for, because debit spreads will allow you to take advantage of that big move with limited risk. Now, generally speaking, when you're trading debit spreads, they are better in lower volatility environments, but I want to make sure people understand that that's not necessarily a requirement. They're just better in lower volatility environments, but nothing says that you can't trade a debit spread in a high volatility environment. Conversely, for credit spreads, This is really when you expect a neutral or modest move. So if you expect the stock to move in one direction or another, but you don't expect that move to happen very quickly or very fast, that's when you would want to utilize a credit spread. Now, these are really good for those of you that use technical oscillators. So if any of you use technical indicators like RSI or MACD or stochastics, please type them into the chat window which indicators you use, because these types of indicators, generally speaking, are best for trading credit spreads. So if any of you use RSI, stochastics, MACD, please type them in the chat window. So some of you, looks like some of you use CCI, Commodity Channel Index. A few of you have says RSI, some use PMO. So very similar technical indicators. They're all trying to achieve the same thing with slightly different calculations. They're telling you overbought or oversold. So overbought tells you that a stock is relatively at a high extreme and is likely going to pull back, and oversold tells you that it's at a very low extreme and it's likely to move higher. So these are the types of conditions that are generally best for trading credit spreads, and I'll show you that in a second as to why. And credit spreads, generally speaking, are better in higher volatility environments. But like I said, that's not a requirement. That's just when they're optimal. You can certainly still sell credit spreads in a low volatility environment, just for those of you that are using these types of trades or looking at volatility when you're entering your credit or debit spreads. So what I wanted to do now is illustrate, for those of you that use technical analysis, when it's ideal time to use debit spreads, when it's ideal time to use credit spreads. So here I've identified a stock that was in trading at first in a very wide range, then was trading in a slightly narrower range until it kind of reached this apex of a triangle. Once it reached that apex of a triangle, it looks like it was about to break out, and once it broke out to the upside, that's when we had the indication that the stock was really going to move in one direction or another. As you can see, it moved from about 99 to 105 in a very short period of time. These are the types of ideal setups that you want to look for when you're trading debit spreads. Now, one thing to keep in mind, because these types of setups don't come along very often, and you might find them in different stocks at different times, debit spreads is typically the type of strategy where you're trading them on all different types of stocks all the time. Conversely, if you find a stock that's trading in a range-bound range where it's kind of oversold, like as you can see, I have a stochastics indicator here at the bottom. It was oversold here around 101, then it reached all the way around 103 where it became overbought, and then it came back down to 101 where it became oversold again, and vice versa. It oscillates between this overbought, oversold, overbought, oversold, overbought, oversold. And what you can do is you can, as it hits this bottom support level around 101, that's when you can sell a put credit spread, another put credit spread, another put credit spread, and another put credit spread. And when it reaches the top of this range and it's oversold, you can sell a call credit spread, another call credit spread, and perhaps another call credit spread. So as you can see on credit spreads, you tend to trade them over and over again on a single stock, versus on debit spreads, you tend to trade them on lots of different stocks. So that is one also small difference between trading debit versus credit spreads. So for those of you that trade credit spreads, you'll tend to find that you're going to trade them over and over again on the same name. And for those of you that trade debit spreads, you're going to find that you're probably trading them on all different kinds of names all the time. Okay, so key difference, making sure you understand when to deploy each one, really, really important. And I will show you to the two side by side in a few minutes using OptionsPlay to really show you and drive home this point as to why they are so different. So when we're talking about debit spreads, with any type of trading, risk management is absolutely key. So like we said, with debit spreads, the entry strategy is really simple. You want to time your entry with an expected large move in the underlying stock. So you see a stock breaking above resistance, or you see a stock that's about to take off or about to break down, whatever that is, if you expect a large move, that's when it's time to enter a debit spread. And and as far as exiting the strategy, this is personally why I also like to trade debit spreads, because they are, generally speaking, in my opinion, a little easier to manage because it's pretty straightforward. You want to exit all debit spreads before expiration at either a gain or a loss. So basically the trade either goes in your favor or doesn't go in your favor. Either way, you either want to take profit or you want to cut losses before expiration. And that's one of the key differences between trading debit versus credit spreads, is that debit spreads, and this holds true for if you're just buying calls and puts as well. you do not want to hold these trades to expiration. You want to exit them before expiration. And you want to cut your losses if the expected move that you're seeing if it simply doesn't materialize. So in this example here before, if I'm expecting this to break higher, but instead of breaking higher, it kind of just falls back to the support level, then it's time to cut your losses, move on. And the goal here, or the rule of thumb that you can use for cutting your losses, is that for debit spreads, whenever you've lost 50% of what you paid for the spread, that's when it's time to cut your losses. No matter what, doesn't matter how much time is left in the trade, doesn't matter what you think is going to go on with the underlying stock. If you've lost 50% of the trade, get out of the trade. Cut your losses, move on to the next trade. For taking profits, it's just the exact opposite. If it reaches about 75 to 100% what you've paid for that debit spread, time to take at least partial profits. If you're trading just 1 or 2 contracts, you should probably take all profits. If you're trading 5 or 10 contracts, you can take partial profits. You can take half the position off, take those profits and leave the other half if you think the stock's really going to continue going, but you want to at least take some profits at about 75 to 100%. So fairly straightforward rules on how to manage a debit spread. And again, that's really why I prefer trading them. The less rules there are and the simpler it is, the easier it is for me to follow and not have my emotions come into play. Because your emotions sometimes is probably the worst thing that gets between you and profitable trading. So the less rules and the more simple your rules are, the more likely you're going to stick to them. And that's personally why I prefer trading debit spreads. However, when you're trading credit spreads, and I still trade them myself, I'm not saying I don't trade them, that's just a personal preference. When you're entering credit spreads, same thing, risk management is absolutely key. Like I said, you want to time your entry of a credit spread with an expected top or bottom. So that's really going back to this chart. When you expect a chart has bottomed or an indicator has reached oversold, that's the time to enter a credit spread. Vice versa, if the stock is overbought and it's reached overbought indicators, then it's time to also initiate a call credit spread. So you want to initiate them with expected tops and bottoms. You can string calls and puts together, meaning you don't actually have to wait for a call credit spread to expire before you initiate the next put credit spread. You can actually continue to string them together one over another. They can even overlap in terms of expirations. That's okay. That's one of the cool things about trading vertical spreads. Like I said, you could end up trading the same name, trading multiple vertical spreads on the same name. So slightly different way of trading. The difference between credit and debit spreads is that your exit strategy is completely different, because when you're trading credit spreads, the goal is to actually let the credit spread expire worthless. So you actually want to hold these to expiration, and the goal is that they expire worthless and you keep all the whole credit that you received up front. Now, if the trade doesn't go in your favor, this is where it gets a little trickier, because it depends on how much credit you've received with respect to the width of the vertical. So we talked about the vertical width is the distance between the two strikes. If the premium that you received is greater than 20% of that vertical width, you want to cut your losses when you've lost anywhere from 75 to 100% of the credit that you received. So if you received $1 in credit and that spread is now trading at $2 or more, time to cut your losses. However, if you've received less than 20% of the vertical width, so if let's say you're trading a $10 wide vertical or credit spread and you've collected only $1, so less than 20% of that vertical width, then you want to give yourself a little bit more room. You want to cut your losses when you've lost anywhere from 100 to 200% of the credit that you've received. So this is really where, depending on what type of vertical spreads you trade, whether you trade a high probability of credit spread or a lower probability of credit spread, there is different rules on how to manage them. So trading credit spreads does require a little bit more experience, in my opinion, to trade them, but there are some rules that you can follow. Just that it gets a little bit more complicated, in my opinion, which sometimes makes it a little harder to remember and stick to. So that's why, again, my personal preference is to trade debit spreads, because those rules are pretty straightforward and they stay the same regardless of what type of debit spread you're trading. So with all of that, let's actually start taking a look at some actual trading strategies and take a look at some comparisons between the two. So what I have here is OptionsPlay Canada. For those of you that are brand new, this is a free tool available to you through the Toronto-Montreal Exchange. If you don't have access to it, please make sure you use the link in the slides that I'll send you afterwards, because it does include the links on how to sign up. It's free of charge. You'll get access to the exact same tool I'm showing you here. I'll make this a little bigger so everyone can see. For those of you that trade US securities, make sure that you sign up for the US version of OptionsPlay as well. There is a link that's going to be included in the slides that I send you. So for those of you that are brand new, I hope we welcome you. The reason that we're doing this webinar is really to help you guys learn more about options trading. The reason we created this platform 5 years ago is because we looked at pages that look like this. So if any of you have ever traded options, you're probably familiar with this. If you are familiar, or if you have traded using an option chain, please type yes into the chat window. If you've never seen the screen before, please type no, just so I get a feel for the experience here in the room. If you have used an option chain before, or seen one of these pages before. Okay, so pretty much all yeses. I got a 1 no here. So for those of you that have never traded options before, this is the type of screen that you typically start with. It's got every single expiration, every single strike price. And for those of you that are brand new, this is kind of overwhelming because you might not know where to start. You certainly don't know which strategy to use, which expiration, which strike price. There's a lot of things that you got to first pick before you can even look at starting options. And for those of you that have traded on this page, one of the things you'll notice is that it's really difficult to compare one strategy to another. So if you're trying to compare buying a call to a call spread, or comparing a debit to a credit spread, or comparing one expiration to another expiration, these types of things you can't really do from a page like this. Let alone, once you've picked something, you have to go to some other screen to see those analytics. So that's why we wanted to put everything that you needed to know on one page, so that the charts that you read, the analysis that you're looking at is all on the same page that you use to select your strategy, select your expiration date, select your strike price. So this platform itself is divided into 3 sections. We have trade idea and watch list here on the left. This is designed to give you an idea as far as what to look at. We have fresh ideas, bullish and bearish ideas that are presented to you every single day. You have a watch list that's pre-built for you with symbols that are already popular amongst Canadian traders, pre-built for you, allowing you to sort and filter this watch list to quickly find which strategies or which trades you're interested in trading. The middle panel is our security analysis panel. This is designed to give you an understanding as to what's going on with that stock. So for any stock you type in, it's designed to give you a quick snapshot of the current trend and relative strength of each stock. So MG is a stock that triggered a bearish trading idea today. So we're going to take a look at this as our setup for today. But everything that you need in terms of technical indicators, support and resistance levels, earnings and dividend dates are all here on your screen, on one screen, so that you see everything that you need in order to decide, am I bullish or am I bearish on a specific stock? And then lastly, the actual trading and income tab, where you select the trading strategy, select your expiration dates and strike prices, are all presented to you here on the right, visually speaking. So instead of giving you that full chain and telling you to pick something, we actually start you off with a few strategies that make sense. Regardless of whether you're bullish on a stock, we'll present to you 3 bullish strategies, like buying a stock, buying a call, or buying a call vertical. This is that debit spread that we're talking about. Or if you're bearish on a stock, we'll show you how to short the stock, buy a put, or buy a put vertical. This is the other debit spread that we're talking about. So this is designed to get everyone to starting point very, very quickly without having to pick anything, and presenting you the 3 most popular strategies for any given outlook. So what we have here is, I'm going to look at MG here today. As you can see, the 1-month and 6-month trend is bearish. It's been bearish for quite a bit of time, and as the stock recently broke below a major support level around 75, actually broke that support level, came back to retest that level, and is starting to move lower again. So these are all the typical things that I would be looking for a bearish trade. Now, I'm simply picking this out because I found this here today. This is not by any means a solicitation to trade this stock or any options in the stock. I'm simply using this for illustrative purposes. As you can see, this stock also recently reached overbought. So this would be ideal candidates for both a credit spread, but this also can potentially be a candidate for a debit spread because it's bounced, it broke below that support level, came back to retest it, and starting to move lower. So you can make a case for either one. So I really want to take a look at both and evaluate this from a perspective of of looking at it both ways and comparing a debit versus credit spread so that you guys can see both scenarios and see exactly how each strategy performs. So MG's trading at $70. I can either short the stock, I can buy a put, or I can buy a put vertical. So this put vertical here is that debit spread that we're talking about, where we're buying the at-the-money puts, roughly a 72 put, and we're selling the 64 put against that to offset the cost. So as you can see, buying a 72 put cost me $325, but by selling the 64 put against it, that offsets some of that cost down to now $267. So now my absolute dollar risk is actually less because I'm only risking $267 versus $325. However, we're not going to be comparing these three strategies. We're going to be comparing a debit spread here, which I have here on the right. I'm going to compare that to a credit spread. So here what I'm going to do is I'm going to do a short call vertical using our strategy constructor. Again, you don't have to construct any strategies manually. Our constructor will do it for you. So once we're going to select bearish, I'll select a short call vertical, which is the debit spread. Like I said, when we're trading debit spreads, we typically like to do shorter dated options. So right now, this is selecting October expiration. I'm going to actually select the September expiration, a shorter dated option. And we talked about selling a out-of-the-money call versus an out-of-the-money put. So here I've sold a 71.73. So this is $2 wide. The distance between those two strikes are $2. So for a $2 wide strike, I want to collect a third of that, which is roughly 67 cents. So as you can see, when I've selected the September 27, 71.73 call vertical, it gives me exactly that amount, 66 cents. So almost like ideally what I'm looking for, 1/3 the width between the distance between the two widths. So I'm going to stick to these strikes for 1 second for illustrative purposes. And what we're going to do is we're going to compare this to this October 19th, 64.62 put vertical, the debit spread. So MG's trading at $70.31 right now. What I want to do is I want to look at a few different scenarios and see how the debit versus credit spreads compare to each other. Walk you through a few different scenarios so that you yourself can decide which strategy is actually best suited for you. In order to do that, what I'm going to do is I'm going to use our P&L simulator. So for those of you that have learned about the Greeks and have learned that how to look at option pricing, you'll see that the Greeks provides you with that calculation as to what you should expect your option to be worth sometime in the future. However, I don't love talking about the Greeks because number one, it confuses a lot of people. Number two, once you learn how to do it, you still have to do those calculations manually. Our platform actually does all of the calculations for you. So not only do you not necessarily have to learn those terms, you only have to know how to use our P&L simulator to really still get the benefits of understanding Greeks. So Magnum International is trading at $70.31. We talked about, we feel that this stock is overbought. It's starting to turn lower. It got rejected off a $75 resistance level. So the question is, how far lower do you think it's going to go? So recently it was just at $68. So I think that's a good target for us to target as a first place to look at. So as you can see, actually, before we compare the debit versus credit spreads, what I want to do is I want to make sure that we're comparing apples to apples. So first, what I want to do is I want to say I'm willing to risk, let's say, $2,000 on this trade, just so we're selling the same number of contracts. So if I'm willing to risk $2,000, I can sell 14 contracts of the credit spread, or I can buy 7 contracts of the debit spread. As you can see, I'm risking roughly the same amount of money. On the credit spread, I'm risking $18.76. On the debit spread, I'm risking almost the exact dollar amount, $18.69. So now I'm comparing apples to apples. So when I use the P&L simulator and I say that if I think the stock's going to go down to 68, traditionally you'd have to figure out the delta of the option, then figure out how much the stock's going to move, and then figure out how much the option's going to worth. We do all of those calculations for you and just tell you exactly what you really need to know is how much profit or loss am I going to expect. So if the stock moves down to $68, as you can see, the credit spread gives you a $924 profit. The debit spread gives you a $931 profit. So the two are almost identical. So keep that in mind. So if you're looking at a small move, you might see that these two trades are virtually identical. But let's actually back up. What happens if MG just stays exactly where it is? What happens if on expiration the stock stays exactly at around $70.33? As you can see, if you had sold the credit spread, you make the $924 profit, but if you had bought the debit spread, you actually lose $700. So again, this is where when we talked about whether you should trade debit versus credit spreads, debit spreads is only good for when you expect a large, quick move. Credit spreads are good for if you expect a neutral or modest move. So as you can see, if the stock stays where it is or stays neutral, the credit spread is going to give you that $900 profit. The debit spread is going to give you a $700 loss. So clearly, if you don't think it's going to move anywhere, or if you simply think it's overbought and it's not going to move much higher, then you want to sell a credit spread. However, if you expect the stock to move lower to 68 or perhaps even lower, 68 I think is a pretty conservative target considering it was just there last week. So as you can see, if it went to 68, you're pretty much break even between the two. But if it moved any lower to 64, as you can see, this is really where the debit spread will start to take advantage. So here on the credit spread, you're still going to be limited to the $924 profit. So if you expect a big move, the credit spread does not fully take advantage of that big move because the credit you receive up front is the most amount of money you can make. Versus here on the debit spread, if the stock just moves down to $64, which is $6 lower, as you can see, instead of making $924 profit, you're going to make a $3,700 profit. And again, keep in mind, these two strategies have the same amount of risk. You're risking roughly $1,800, $1,900 on the trade. But if you expect a big move in one direction or another, the debit spread is going to give you the much, much higher profit. Versus if you expect a modest move to 68 or 65 or 69, this is where you want to trade that credit spread, because as you can see, if the stock stays at 69, you're going to receive that full $924 profit, $924 profit versus $1,800 risk. Versus here, you actually only make a $231 profit. The stock moves modestly lower. So again, this is really where, depending on your views on an underlying stock, if you expect a large move in one direction or another, the debit spread is going to be the best. If you expect a large move in the other direction, a credit spread is going to be the best. I'll try to do one more example just for illustrative purposes. Again, I don't have any particular views on this specific stock. I'm just using this for illustrative purposes. I don't even know if I'm necessarily going to be able to find a credit spread on this trade, but I will certainly try. Let's say we're looking at a 105, 107 and a half. Okay, let's take a look at this. We're looking at BMO, Bank of Montreal. Like I said, I don't necessarily have a view on this specific stock, but it certainly is a bullish stock. As you can see, 1 month and 6 month trends are bullish. Technical score of 8 telling me this is a relatively strong stock. So let's take a look at trading a debit versus a credit spread. Again, I'm going to risk roughly the same amount of money. Let's say I'm willing to risk $2,000 on the trade so I can sell 12 contracts of the credit spread or buy 7 contracts of the debit spread. So BMO is trading at 107.33 right now. So what happens if the stock stays exactly where it is? As you can see, obviously the credit spread here will take advantage of the fact that if the stock doesn't move, you're going to still receive that credit, $522, versus the debit spread actually loses money. So clearly, if you think the stock's going to stay where it is, you should not trade the debit spread. However, if you think the stock's going to move even modestly higher, so let's say, as you can see, if it goes up to 108 and a half, 108.60, which is just $1 above where it is right now. So let's say 108.50. As you can see here, I make roughly the same amount of money, 522 on the credit spread, 455 on the debit spread. But if I think the stock's going to move any higher, if I think it's going to move to 110, as you can see, this is really where the debit spread really takes advantage. So here, risking the same amount of money, instead of making $552, here I'm going to make $1,500. So again, depending on what your views are on the underlying stock, you think it's going to make a fairly large, quick move in one direction or another, debit spread's going to be better. If you think it's going to stay fairly modest or neutral where it is, credit spreads are better. Once you've identified the trade that you want to make, so if let's say you think BMO is not going to go much higher, you think the credit spread's the right trade to make, clicking on the trade button will bring up the strategy checklist. This also gives you the details on how to enter this order into your broker's platform. So if you're trading anywhere, regardless of what your broker are, this gives you all the details that you need to know how to enter this trade into your broker's platform. Very important, making sure that you enter all of these quantities and buy to sell, expiration, strike price, type, and premium all correctly. And lastly, making sure that you understand that there's a strategy checklist here for you, just to make sure you understand all your risks before you place a trade. This is especially designed for those of you that say that you're new to options trading. I want to make sure that you guys understand every single risk before you place your trade. And we created this strategy checklist to help prevent some of those beginning mistakes that sometimes people make because you didn't know to look out for certain things. So we want to make sure you're trading with the trend of the stock, trading with the trend of the market, making sure the OptionsPlay score is good, checking if there's earnings between now and expiration, and lastly, spread and liquidity. So make sure you take a look at that strategy checklist before you place any trades and enter the trades into your broker's platform as per the details in the trade ticket. So with that, that concludes what I wanted to show you guys here today. Like I said, you can utilize this platform for a lot of different things. Whether you're bullish, you can take a look at 3 bullish strategies or click on I'm bearish and we presented 3 bearish strategies. This is all designed to give you guys ideas for regardless of whether you're brand new and you don't know where to start, or if you're an experienced trader, this helps provide you with starting points so you can look at different expiration dates and strike prices and quickly modify them, change the expiration dates, change the strike prices very quickly just by the click of a mouse and be able to analyze different strategies without having to get boggled down necessarily by pages and pages of these types of chains, trying to select the right strike prices when you don't really know where to start. And this is designed to facilitate all of that. And then more importantly, making sure that you use the P&L simulator so that regardless of what your views are on where you think the stock's going to go, this tool will provide you with all the details so that you never have to calculate Greeks or deltas or theta or anything like that. It just does all of that work for you and lets you focus on the most important thing as to how much profit or loss you'll actually receive for each one of these strategies so that you can quickly compare and start trading them immediately in your accounts. So with that, what I'm going to do is I'm going to open this up for Q&A. And before I just do that, you can start typing your questions into the chat window if you have any questions. But I want to make sure, again, to reiterate, for those of you that do not have access to OptionsPlay, you can get free access to OptionsPlay Canada through optionsplay.com/TMX. And for those of you that are interested in using the same tool for US securities, we do have a free 30-day trial for everything I just explained to you here right now, and a 20% discount for Canadian users. Just go to optionsplay.com/income and you'll be able to get access to the same tool for US. So with that, what I'm going to do is I'm going to open this up for Q&A. Any questions, please type them into the chat window and I will answer as many questions as I have time for. Thank you very much. So I have a question here. I believe I also had a question here during the session. Let me scroll up here. Are debit and credit spreads also known as bull-bear spreads? Absolutely. So sometimes they are called, let's see. So sometimes this is called a bull call vertical and a bear put vertical, and this would be called a bull put vertical and a bear call vertical. So absolutely, you are correct. Sometimes they are known as bull and bear instead of long and short. How much volume should your stocks have for trading spreads? Really good question. So the question was, how much volume should the underlying stock have before you should take a look at spreads? I would say that, you know, the best indicator, in my opinion, is you don't necessarily have to look at the volume. You can just look at the OptionsPlay scores of the options that you're trading. So you tend to find that on the smaller cap names, let's see. So here, this looks pretty good. You get yellow scores across the board telling you that there's pretty much a decent liquidity in something. But on some, for example, on this one, this is a smaller cap name. As you can see, only 104 shares traded on the underlying shares. As you can see, the OptionsPlay scores are pretty poor. So this is an indication that liquidity is not very good. So I would just use the OptionsPlay score. I wouldn't necessarily have to dive into the volume because volume also depends on the price of the stock. You know, lower price stocks will have high volume, high price stocks have lower volume. So it's always hard to say that. So always use the OptionsPlay score. That will give you an indication as to whether you should take a look at options trading on that stock or not. How much? Oh, I think that was the same question that was just asked again. I hope that answered your question. Question here. Amazing tool. Seems very useful from your presentation. Looking forward to explore it further. Is there a copy of this made available after? Yes. So this webinar is recorded, and everyone that has registered will receive a link to the recording and the slides, so that you will have the links that I'm referring to in the slides that you're looking for. For spreads, do you need to own the underlying stock? No, you do not need to own any underlying stock to trade debit or credit spreads. Unlike covered calls is the only strategy where you need to own the underlying stock. You can buy and sell debit and credit spreads without owning any of the underlying stock. Great question. Can you view U.S. options via the Canadian platform? Unfortunately, you cannot, and it's because the TMX only wants you to have access to the Canadian version free of charge. They are not paying for US access, so that's why they are separated. What is the difference between volume and open interest? So volume is simply referring to how much was traded today on a specific expiration and strike, versus open interest is referring to the number of open contracts that have ever been opened. So one is just for today, and one is kind of the whole history of it, if you will. What happens when your short position gets assigned? How do you handle this situation? So that depends on whether you're short the call credit spread or the put credit spread, but your broker should be able to offset your long leg to help offset that. So that's really a question for your broker. I would call your broker and say, on debit spreads, again, you always have one long leg and you have one short leg. So one leg will always go to offset the other. If you get assigned, you can always exercise your long leg to offset it, but your broker should automatically do that for you. So again, it depends on your broker. I would suggest you to call your broker and ask them that question, and ask them how they handle it. There's a question here of how can I use this platform to roll out of a call option, roll up a call option, or both? So you would use it the same way as if the way I view a roll, and for those of you that don't know what a roll is simply when you're closing an existing option position that you have and you're opening up a new one, either a further dated expiration or a higher strike or lower strike. The way to view a roll is to first figure out what you want to own after the roll, because so for example, if we're looking at BMO, if you've already owned a call on BMO and you want to roll it, then the question isn't necessarily what you want. The question is, what would you like to own after the roll? Give me 1 second here. It looks like I'm having some internet issues. So BMO is trading at 107 right now. Let's say you own the 105 strike calls and it's now in the money and you want to roll it. So the question is, what do you want to own afterwards? And you can use OptionsPlay for that. So here, as you can see, we're saying that looking at the October 19th 105 call is a good place to start if you're bullish on BMO. So this is probably where you want to start. If you're trying to roll, you want to roll out to the October 19th 105 calls. This is how you would utilize our platform to help you figure out what to roll to. Which spreads give better returns? I'm not sure how to answer that question, because like I said, the two are completely different. You use them for completely different scenarios. One is for when you have a bullish view on a stock. One is when you have a fairly neutral view on the stock. You can't compare the two. You can only compare the two side by side. When you put the two side by side, like the example that I just gave here before, you can see which one has the highest return depending on what your views are on the line under a stock. So before I was looking at a short call vertical on MG. So when you're comparing the two side by side, depending on where you think the stock's going to go, our platform will tell you where you get the better returns. To sell, do you need to own the shares? Yeah, so again, to answer that question, no, you do not need to own the shares. Austin's asking LB. I don't know what that question means. If you wanted to look at a specific stock, did you have a question on the stock? Happy to answer any questions, but I'm not sure what question you have for this stock. Question here is, I have a call option. How can I use this platform to compare choices to roll? Yeah, so you would use this to look at a call option. So for example, going back to the BMO example, if you're looking to roll your call option on BMO, you would use this tool to modify if you want to change the expirations and strike prices. And then you would, based on what your views on where you think BMO is going to go, you can use our price slider, and that helps you determine. You can even compare different options. So let's say you want to compare let's say you wanted to compare an October 108 call to an October 105 call, and you want to compare that to, let's say, a December, 105 call. You can put the three side by side, use our P&L simulator, say I think the stock's going to go to 115 by a certain date. Let's say you think it's going to do that by November. Then you can actually compare these three strategies. So here it'll tell you that the October 19th 108 calls will give you the highest return out of these three strategies. So this really allows you to compare whether you want to roll out, roll up, or roll both up and out. What is the price structure to use OptionsPlay for both Canadian and US? Like I said, the Canadian side is free of charge to you. The US side is $40 a month or $400 a year if and only if you use this link. So this gives you the 20% discount. So instead of $50 a month or $500 a year, it's $40 a month or $400 a year, but only if you sign up using this link for the US side. How do you start a spread? Great question. Like I said, if you're ready to trade the spread, you hit the trade button. You want to enter this trade into your broker's platform. Sorry, not this one. Let me go back, reset legs. You want to hit the trade button. You want to enter the trade into your broker's platform as a single strategy. That's how you start a spread. You want to make sure that, and if you've never traded a spread before, I recommend you to call your broker and say, can you walk me through my first spread trade? They should be able to help you enter that order properly so that you have someone at your broker, because it does vary from broker to broker. Make sure you call your broker up and have them walk you through it. How do you close it? Do you wait or do you specify upfront when to close the position? So that also depends on your broker. Some brokers allow you to put in orders that allow you to close it out at a certain time in the future. Some brokers do not. So again, please call your broker. They should be able to help you out with that. In terms of when to close it, that's where, it depending on whether you're trading a debit spread. These are the rules for cutting your losses and profits. Or if you're trading credit spreads, you either want to let it expire worthless, or you want to follow one of these two rules depending on the type of credit spread that you're selling. So, and these are in the slides. So if you want to reference these, you'll get them in the slides, and that will answer your questions as to how to close them. Is the roll basically closing the open position and opening a new one? Yes. So rolling is specifically referring to closing the open position and opening a new position in one single order. That's what we call a roll. Vic is asking, if bullish, can one buy a call or a debit spread? Absolutely. That's the whole point. What we're trying to compare is buying a call to buying a debit spread. Debit spread protects against time decay and would be cheaper because it also gets some credit from premium sold. Why would one choose to choose a naked call instead of a debit spread? That's a really good point. So here's the only time where it makes sense to trade a call versus a debit spread. So the question is, if the debit spread gives you lower risk, it offsets the time decay, and it gives you a lower break even, why would you ever trade a call option? And that's a really good answer, and that's a really good question. And there's really only one scenario where it makes sense to just buy the call instead of buying the debit spread. Now, when I talked about the debit spread having that time decay factor, let me bring up another spread that I think is a better example here. So let's take a look at this. Let's look at like the October 105. There's not a lot of strikes here on this particular one. Let me see if I can find another stock. Let's look at TD. TD tends to usually have a lot of, okay, so here's a good one. So let's say we're bullish on TD. We're buying either the call or the call spread. And the question is, when is it better to buy the call? And the answer is that if you expect a really quick move to happen over a very, very short amount of time, and usually this is really limited to big catalysts like earnings or a news event, or you expect economic news to have a huge impact on a stock basically instantaneously, that is the only time where it makes sense to make a call, to buy a call. So for example, as you can see, if let's say the stock is trading at 78 today, and you think it's going to make a really big move up to 82 on earnings or something like that, some kind of known catalyst in a very short period of time, and TD doesn't have any earnings, but let's say it does. Let's say it has earnings next week. Let's say it has earnings next Wednesday, and you expect that by the end of the week, the stock's going to be at 82 or 83. As you can see, If you had bought the call, you're going to make 192% return, versus if you bought the call spread, you only make 112. Obviously, 112 is not a bad return, but it's much, much lower than just buying the call. So if you're really expecting a very quick move to happen in a very, very short period of time, like I said, like an earnings event or a news announcement or economic news, that is the only time when it makes sense to buy a call, okay? So I hope that I answered that question. That was actually a really good question. And someone else just brought up a good point. If you're trading in a RRSP or TFSA, which I'm guessing is a retirement account, you can't do spreads in these accounts. I'm not as familiar with the restrictions on retirement accounts here in Canada as I am in the US. In the US, you can trade spreads. Perhaps in Canada, you cannot. If that's the case, then that is when you want to buy a call. But like I said, the only time it makes sense to buy a call versus a debit spread is when you expect a large quick move on a catalyst event where it happens basically instantaneously, not over a period of time. That's when a call or a put will make more sense. So at this point, I've gotten to the end of the questions. Does anyone have any last questions before I sign off here for today? What are the other webinars that are available? Great question. So you can click on the link and that will show you what the other recordings we have that are available. But we have quite a few that are available to you. So we have how to trade earnings, how to generate income, finding your directional edge. For those of you that are getting started, trading your first option, how to leverage technical analysis with options trading. And now that we have the debit versus credit spreads, the next two webinars that I'll be doing is specifically on credit spreads and specifically on debit spreads. There is a question about any plans for a Toronto event again. Yes, I will be at the Toronto Options Education Day with the TMX in early November. So for those of you that attended with us last year, I will be doing that again this year. I hope to see some of you there. But I highly recommend you to please make sure that you take a look at our webinar recordings for those of you that are newer to this platform, because it does walk you through a lot of different other strategies on how to utilize our platform with those strategies. So I hope you guys have found this useful. Unfortunately, I won't be making it to Vancouver this year, but I am at the Toronto Options Education Day. Someone's asking what day it is. Let me see if I can find out. I believe it's November, the second week of November, not the 3rd, but the week after that, I believe, is the week for Toronto. I don't see the date right here, but it is, if I'm not mistaken, the second weekend, the second Saturday of November, if my recollection serves me well. Raymond, thank you very much. I really appreciate it. Vic, thank you very much. I really appreciate the kind words. Any other last questions before I sign off? If not, I just want to thank everyone for taking the time out this afternoon. Please make sure you take a look at the recording and the slides. Very useful links in there. I hope to see you guys next in a couple of weeks. Like I said, we're going to cover specifically debit spreads and a specific webinar on credit spreads for those of you that are more interested in these two strategies. Thank you very much. I hope you guys have a great afternoon.